Okay, hi, good to see everybody. Hi, XLD and Ivan can trade and everyone else. Good to see everybody. Um, okay, welcome. My name is J Norris, and let's take it from there. As usual, we need to point out that trading involves risk of loss and is not suitable for all investors. It definitely is a risky endeavor, as we often say before we do courses and at the beginning of our on-demand courses. We always point out that it's not for everybody, and if you have bad habits in life, they tend to be magnified in trading. We don't like to hear that often, but it's a fact. My name is J Norris. I spent 20 years on the floor of the Board of Trade. It was a pretty interesting experience. Pretty different from how we all trade now, though, that's for sure. That was a long time ago. Since then, I've also written a couple of books on trading, which were published by McGraw-Hill and serve as textbooks for our courses. The tactic we're going to show you today is highlighted in the book on the right. What makes these books unique, I realize, is that they both include trading plans, which allow you to take the information we've given you in the book and backtest that. And that's very important for us. Transparency, no doubt about it, is a bulk work in what we do. I also teach at IBUniversity. I'm a director of learning here, where I spend a considerable amount of time demonstrating the art of discretionary trading in live markets. The methods we teach are both mechanical, and that we give you a mechanical framework for defining the patterns and as always, direction in the market, which is what we're going to cover today. They're also behavioral in that you have to take into consideration the day-to-day fundamental news events that shape the market. You have to take into consideration the Keynesian policies that shape and influence the business cycle. So it's, I guess, in modern terms, we think it's both technical and fundamental. That's an important consideration for me. You'll never hear me say technicals versus fundamentals. They're one and the same. We understand that the pattern we see on the chart is absolutely a reflection of everything that's going on in the marketplace. It's a very important part of our philosophy in teaching trading and my own philosophy as a trader. I've added a slide to the presentation. I think this is very important that you recognize what your goal is as a trader. A lot of people fail at trading because they have a wrong goal to start out with. Setting goals in trading is different than setting a goal in most everything else, because in most everything else, repetition doesn't mean you're going to be repeatedly losing money, right? On the other hand, if you don't know what you're doing on trading, that's what's going to happen. And I'm sure a good percentage of you guys and gals have thought about that. What what should your goal be? So if you guys can, let me ask you, if some of you guys, I know there's some experienced traders here, what would you say your goal would be, just off the top of your head? I think a lot of people will say make money. That's for sure. You guys are a little quiet this morning. Well, we'll get right to it. Yeah, ultimately to make money, FX learner for sure. Consistency in taking signals. Spin doctor, yeah, my man. Good to see you. Yeah, I'm here. Yeah, Ivan, be consistent. Hey, Boyk, yes, yeah, you guys got it down pat. Lower risk, higher reward. That's all really good stuff. And FX learner's right. Ultimately, to make money. Yeah, I've seen a lot of people that were successful at other things because they had a goal, they had a formula, they had a plan, and they were good at executing that plan. But when it comes to trading, I've seen them flame out pretty quickly because I think a lot of it has to do with they didn't understand what that goal is. You guys have a lot of experience, and I can see you guys are on the right track there. From my perspective, the goal needs to be peace of mind. We trade for peace of mind. You trade for security, which is ultimately money, which is going to provide you that peace of mind. The formula and plan to achieve peace of mind, of course, is going to be much different than if you had a formula and plan just to make money. So when you approach it from that standpoint that it's ultimately giving us peace of mind, then every step along the way better give you some peace of mind. If you're uncomfortable at any step of the way, you've taken a wrong turn. If you're uncomfortable, you're getting away from peace of mind. As a trader, you should gravitate towards peace of mind, incremental gains, and you have to shake it off and laugh when it's you that got in the way, when you didn't pull the trigger when you should, because you know, hey, that's not the method, that's me. To err is human, and boy, it's amazing when I sit down and think about it now, being 50 years of age. Next week, like, man, how often have I been wrong? You know, a lot, and then that's just human nature. You're going to be wrong a lot. Even smart people are going to be wrong a lot. We're all going to be wrong over time. So it's interesting, you know, how much we thought we knew when we started out in this game and what we know now. But it's important to focus on that you trade for peace of mind, and every step, every incremental step you take should make you a little bit more comfortable, should make you a little bit more confident in what you're doing. Before we get into trade selection, a few words on methodology. The first thing you'll need to trade successfully is have a trading method which works in all environments. It took us 4 years to put together a trading course that teaches an objective empirical method that you can use in all trading environments, meaning up markets, down markets, sideways markets, regardless of shifting conditions, regardless of the day-to-day news flow. You have to have that. And what is that going to give you as a trader? Peace of mind. I know it's easier for me to be patient and stick to my plan because I'll get the opportunity to participate in those lower risk, higher reward setups and trades. And Boyke knows what that means. Now, notice I said patience. I know that while markets certainly trend, which can make trading pretty simple, and definitely that's a condition where you'd want to trade every day, they also counter trend, and that when a market does exhibit counter trending behavior on a relevant time frame, then I'm likely not going to trade that day. So I'm patient because I know that my goal is not to trade every day, but to take those setups and signals, which I identify as being attractive in the context of the pattern, first of all, and then risk reward. So yeah, your short-term goal, every step of the way, your trading plan has to lead to that ultimate goal of peace of mind. I definitely have greater peace of mind because I know that as price moves through time, it will continue to give us all attractive buy and sell setups, and it's just up to us to be on our post and take those trades and manage them according to plan. If you're going to trade, you definitely need a method for all seasons, and I'm going to show you a couple of trades in the Australian dollar that I saw today, and hopefully you'll be in line with that strategy of, you know, you can see you want to trade with the trend, and you could trade counter trend if you're good. In my book, you know, if you have a couple patterns aligned, you can take that shot. I'd rather wait for the trend trade when I have more than just a couple of patterns aligned. I want to have three because to me that's more attractive. FX Learner, great question. Hi, Trying Trader. Oh, thank you very much. Yeah, I'm telling you, I love those books. Sometimes I'll occasionally pick them up and flip through them. I'm like, wow, I wrote this. You know, it's true that you know, sometimes there's a different power that comes in you and moves that pen, and I can tell you firsthand. But yeah, FX Learner, that's a great question. That was the question I had to ask myself when we had finished with our core concepts course and we are going into our advanced course and graduate, and of course now the master's course. You can't get from the beginning stuff, what we call the core concepts, or the intermediate stuff. Essentially, I think our core concepts is probably ahead of what most other people are doing out there. But you can't get that second step into being a senior, having that senior title. You have to have a method that works in all environments. So FX Learner, key question. That was what I had to ask myself, and I think that's what ultimately we did deliver in there. But I'll show you an example of today where you're going to pick and choose. You're not looking to trade every day. You're looking for, as Boyke said, the low risk, high reward, and Spin Doctor hit it on the head too. Be consistent in taking signals, and Ivan too. Just be consistent. You can never say that word enough. I tell you what, consistency, it's something. I mean, behavior that's rewarded is going to be repeated for sure. So consistency is essential, and repetition in this game really, as the old saying goes, repetition is the mother of all learning. So, yeah, I think collectively as a group, I think we're in pretty good shape here with you guys here. So, you have to have a method that works in all environments. FX Learner, to me, there is such a thing. You're going to have, I guess it wouldn't necessarily be one trading plan unless you include counter trend trading and trading in the same trading plan. But in order to do this, in order where we're going, talking about trading plans, it has to be simple enough that it makes intuitive sense for you. My first trading mentor off the trading floor was a guy named Bill Williams, brilliant man. Bill had a PhD in psychology. He was a therapist. He started learning trading, probably after he got his first paycheck as a teacher. He said, this isn't enough. I got to supplement this. But smart man. And what he said, it just made intuitive sense to me. Now, that didn't mean I knew what he was talking about for months and then years afterwards. He was so smart. He would just say things in the most simple way. And, I fought that myself, thinking it can't be that simple. But it can't. It has to be simple. And he could explain it so simply too. So I think that's essential. That if you're gonna learn, take on a study, create a trading plan from it, ideally go on to have a career at trading. Based on that, it's got to make intuitive sense to you. And who's ever teaching it, it has to be easily explained. And when you get to the point where you're going to trading, you have to be able to explain it pretty easily too, why it's going to work for you. Now, it's always been a mouthful for me. I'm always trying to summarize our method in 3 points. And you guys, I know you've seen this. Most of you guys have seen this before, but I think it bears repeating. And you want to start thinking in terms of trying to define what you do in as few words as possible. Number one, use pattern recognition to identify a market's growth pattern. When we say growth pattern, is the market growing or contracting? It's true. A market's like a plant. It's either growing or it's not. And even when a market's going sideways, we could say, well, they actually do 3 things, and that's true. They go up, they go down, they go sideways. But even when it's going sideways, it's generally telling us something about the previous pattern. Was it growing or falling? If it's going sideways, it's retracing to some degree. The more shallow the retracement, then that's going to speak of the strength of that current growth pattern, be it up or down. Pattern recognition forefront, I think I said this last time, right? What does Fibonacci, Fibonacci, Dow theory, and GAN, however you want to pronounce that, all have in common? And that's pattern recognition. Another word for pattern recognition is really technical analysis. But it's not, as I said before, what we teach is both technical and fundamental, meaning it's both mechanical and it's behavioral. So we use pattern recognition. We identify a market's growth pattern. Pretty simple. Is the market going up or is it going down? Number 2, we use the scales of the growth patterns on lower time frame charts to identify buy and sell zones in line with the higher time frame patterns and the day-to-day news flow. There it started out a technical statement, and it kind of flowed into accommodating the fundamentals. We use the term scale here. We use the term scale in referring to scalability in pattern. A scaled pattern is one where the sum of the parts equals the whole. In fact, the parts themselves are scaled repetitions of the whole. I'll show you that in the Aussie dollar intraday chart shortly. And by the way, that definition, the sum of the parts equals the whole, that's also the definition of a fractal. We're big believers that, as my earlier trading mentor Bill Williams was, that markets typify fractal geometry. So we use the scales or the retracements of those patterns to give us buy and sell zones, specific levels on the chart where we realize that they potentially give us a buy setup and a signal. Well, the zones themselves are setups. The signal would follow. And we're going to teach you the signal today. Now, what's going to help you at this point also is understanding that different time frames are essentially different dimensions in time. And in learning to trade, you'll have to be able to see the different dimensions simultaneously. And I'm going to show you that today. And this is something we spend a considerable amount of time teaching. And I think some people get hung up on this. There's nothing wrong with operating in one time frame right now. I think you have to, in business, you have to be in the now all the time. In trading, however, you have to understand that there's significant things in the past that are going to influence the behavior of traders going forward. And the patterns on the different time frames are going to help. So you have to be able to start to see different dimensions simultaneously. I also need to point out that there's a big difference between analyzing and trading. You need to learn to be an analyst first. Inevitably, you ask a woman, what do you want? What do you need to be first? Or no, what do you consider yourself first, an analyst or a trader? The woman generally is going to say an analyst because she understands women. They tend to understand you have to have a plan in place before you can go out and execute. So I think women are more intuitive in understanding the importance of the plan first before the execution. Men they want to execute right away. They want to get in there and get action. So inevitably men will say, well, I'm a trader. So understand, there's nothing wrong with that. You just have to flip it around. Don't consider yourself a trader first. Consider yourself an analyst first. You have to understand how the market moves before you can get in there and take advantage of that. Okay, FX Learner, do you use retracements on higher time scales to target on your lower? Yeah, absolutely. Yeah, absolutely. You're going to have simultaneous retracements. You'll have retracements on the lower time frames as well as the higher time frames. And it's our job really to wait for those to be aligned, and we'll give you an example in a moment. Third point, keeping it simple. In an effort to keep it simple and define the method, we provide a fact-based trigger to enter and exit trades and show you how to use news and momentum to filter your trade selection, which is what we're going to be showing you today. When I say use news to filter your selection, that's very simple. If you're a short-term trader, exit the trade before the number comes out. Exit the trade before the big number with red in front of it comes out. That's just that'll be spelled out in your trading plan. If you're a position trader, you're obviously not concerned about day-to-day news flow and you're managing a trade on a daily chart. If you're an intraday trader and you're managing your trades on a 15-minute chart or lower, then you don't want to trade in front of red numbers because it's just common sense. The risk-reward is way off. I'm comfortable with a risk on a currency trade, somewhere between 15 and 30 pips. On the other hand, a big number like the unemployment number, or FOMC, can move a currency market considerably more than 30 pips. So if I'm accustomed to risking 15 to 30 pips on a trade, I'm not going to step in front of the train where I can see a 60 pip move plus in a heartbeat. So that's just common sense. That's what we mean when we say use news and momentum to filter your trade selection. Well, use news anyway. Momentum, that's a different story. Trying trader, it may be more important than you think. I'd have to see the specific. He's asking how important is a 1 week change of direction if you take a trade on a 15-minute chart. It's not so much the change of direction I'm interested in. A change of direction is a trigger for me. It's a signal. It's the pattern. I want to probably see that pattern on a 4-hour chart if I'm looking at a signal on a 15-minute chart. Really, what you want to be interested in is the direction on that 15-minute chart. So if you're taking a trade on a 15-minute chart, you're going to take that trade when you have a change of direction on that 15-minute chart in line with the higher time frame pattern. So, hey, what's in it for you? I don't mind you guys asking that at all. That's why you're here. You want to take something away from this that's going to help you, not hinder you. So how can we help to improve your trade selection? And that's it. That's what I can give you. Know when direction is aligned with price pattern. Both those are extremely important. Both price pattern and direction. We always say price pattern first. You have to know the price pattern, then you have to know when direction has changed. I learned a lot over the 4 years it took to put together our courses, and the most important thing was knowing this, knowing when direction is aligned with price pattern, because this determines when to enter a trade and when to exit a trade, and essentially this is the trigger we use. when direction is aligned with price pattern. Before we go any further, however, we need to break this down and define both price pattern and direction for you. And I know that may get a little bit boring for you, the definition, but this is really the meat of it, because when I'm telling you that I can define direction, I'm telling you I can define direction in any market on any time frame. That basically means I always know when there's a signal. It's good to know when there's a signal. That's important for the timing of the market. I also need to know whether that signal is trend or counter trend, basically. And when I say trend, I mean it's a signal in line with the majority of patterns. That's the trade. That's the signal I want to focus on for that lower risk, higher reward setup. Likewise, I want to know when that direction is changed, because that may be a counter trend trade. I may not initiate a trade on that, but I can always have the option of exiting a trade or a portion of a trend trade when I see a counter trend signal, or put a break-even stop on, etc., or take a portion of the trade off, go with a break-even stop, etc. So it's very important that, so I know you guys get kind of boring because we get into the technical issues here. It's like going back to class, right? No one wants to go to class. They all want to go to, they want to see Tony Robbins up there telling you exactly how to do it inside of 10 minutes, right? Nothing against Tony, but it kind of doesn't work that way. So at some point you have to prepare to roll up your sleeves and be a little bored, but remember that, school and lessons are very important to us. So here, let me go back and show. There's two things we're talking about: direction, and we're talking about price pattern. I need to define both of those for you. Price pattern, very simple, is the pattern created by market's highs and lows over time. It's just a matter of marking the isolated highs on the chart, isolated lows on the chart. I love this chart. There's a reason why I haven't updated this chart since we first came together, because it's such a great example of what happened now, right? What happened to price? Price got all the way down here, didn't it? 23. So now price is all the way here. So there was no surprise. We knew in the beginning of April that there was no doubt about it. You had a bearish pattern. So you had a bearish pattern coming in. This is what we call a primary pattern. So the primary pattern was bearish. Now price all the way got down here. That was a lower low. So the pattern is still bearish. So price pattern, very, very important to us. And, you mark that off, and then it's basically going to give you a channel or so you can see where it's going. And it's kind of that simple. And I'll show you where we're going with this. Obviously, you identify that pattern, then you can decide how to play in that market, how to trade in that market. Here's a bullish pattern. You have higher lows and higher highs. This is the U.S. stock market over the past few years. We'll have to update that chart too now and see where where it's going to put in that next potentially lower high or higher low, right? Higher low. Stocks are, by the way, they're still up there pretty good. I think you're still you bottomed out 12 so far, 12 above 12.5 anyway. So somewhere in here. So the stock market's obviously still exhibiting a pattern of lower highs for the big correction you're in the middle of. But it's so important because price pattern, or more specifically, growth patterns, are going to be scalable, meaning these smaller moves that you see on the left side of the chart are often scaled replications of this larger move that you see right there. And you can see that if you're an Elliott-tician, you can see that obvious 3 waves up to you, and you know what that means. Well, let's keep it even more simple. The pattern itself is pretty simple, but what you really want to know is when that price direction has shifted in line with that pattern. That's a critical time for us. An even more simplified way of looking at this is, hey, identify an uptrend, look to buy dips. It's not as simple as buying dips. You obviously want to wait for the change direction back higher, because as long as the direction's down, you don't want to be long. The pattern can be bullish, but if the direction's down, don't do anything. Don't do anything until the direction changes to bullish in an overall up pattern. Pretty simple stuff, amazingly effective though. Scalability, you have to talk about a word on scalability. Definitely is due on my part. It's important that you understand it because it's easy to overlook basic patterns, especially if you're focusing on technical indicators or crowding your chart with other overlays. But if you know to recognize these higher time frame patterns right here on the chart, take a look at those. It's much easier to understand and even now expect these patterns on the smaller scale, the white line on the right side of the chart, and even look at those little blue lines on the far right of the chart. It's much easier to understand and even expect those smaller time frame patterns on those lower time frames. There's no doubt about it. In my mind, it's so ingrained with me that markets typify fractal geometry. Now, the really good news here is not that markets typify fractal geometry. That's good news, but that we as individuals are naturally very good at pattern recognition. It's something you're good at, and you may not even know that you're good at. I see time and time again when I ask people what books they're reading or what exercises they're doing or what do they have an overall method or overall trading plan, and they start showing me all about technical indicators. Technical indicators, in my estimation, is a classic example of the computer getting in your way. Your own ability to recognize patterns is very powerful if you're able to tap into that and harness that. In other words, if you can clear you could shake the screen like an Etch-a-Sketch and just clear everything out and start over, no indicators, and start to put those lines on there, then you're going to start to give yourself a real shot. Now, why this is that we're better at that than the computer is that each pattern a chart creates, each pattern a market creates is wholly unique. And it's generally just a slight variance from the previous pattern. We love that. I mean, I could show you chart after chart after chart where the market just gives you 50% retracements or retracements less than 70%, whatever. But the market tends to get in a pattern. It tends to repeat that pattern. So we recognize the pattern very easily. But because each pattern is a slight variance, you're never going to have a perfect 50%. Well, you have perfect 50% individual 50% retracements. So you're never going to have a series of perfect 50% retracements on that same number. So that's what throws the computer off. The computer needs perfections. We're very good at slight variance. So yeah, the computer depends on what's programmed into it. We're not. We have natural deduction, which is a powerful thing if you're able to clean out a lot of that clutter and see what there is to see. Now, this is why Wall Street doesn't make its money from betting on which way a market's going to go, but they make their money from taking the other side of all our trades, i.e. making markets, and from getting paid a transaction cost, also known as a commission. This is the way it is. If traders, if the big houses knew what they were doing, if they knew what the market was going to do next, you wouldn't have Chase Manhattan blowing $2 billion on an alleged hedge, right? FX learner. So you don't use any indicators? No, I do. I use the MACD. I teach the stochastic. I teach. We teach our core concepts. The technical section. We cover most of the popular technical indicators, and we show you the advantages of them. Definitely pivots are important too. No, we teach those, but price pattern first. Price pattern, momentum, structure, all very important to us. We definitely use indicators to gauge momentum, but I don't teach the indicators until you get into. I'm trying to think in our advanced course when we introduce the indicators. I think it's section 4 under momentum. So if you take what's cool about our advanced course is every tool we use, we give you in that advanced course. The graduate course, the master's course, that's just showing you how to put it together. So we give you, we teach how to use the MACD, we teach how to use momentum, but we don't do it up front. I mean, there's more important things you need to know than momentum. If you're focusing on momentum first, you're just a little matchbox in the wind. You're a little matchbox on a roaring river there. There's more important things that we need to teach you first. So I'm not beating up on the indicators, but I am if they're taught in the direct order, and I definitely am if someone's holding themselves out as an educator and they're showing you indicators first. That's you got to run. But hey, I could be wrong too. Maybe there is a way to do it. RSI. We teach RSI early on. We show you how to. We at the appropriate time we show it to you. So again, Wall Street doesn't make its money from trading. Wall Street makes its money from making markets and on transaction costs. The big Wall Street firms weren't built on trading acumen. Certainly not. Otherwise, Bear Stearns which was a great firm at one point. Lehman Brothers also. If they made their money on trading acumen, they'd still be around and they'd be bigger than ever, right? But back on point, scalability extremely important. It typifies that market's it typifies practical geometry in the marketplace. Scalability and repetition, another great quality of price movement is along with being scalable, it's repetitive. Here you could see it, and this is back in March. You could see you had a negative growth pattern in the Australian dollar, and it was just simple, literally, as drawing counter trend, putting counter trend lines on the chart, right? And you just drew those support lines, and every time a support line broke, you knew that it was likely you were going to, especially after it happened here. After you had a lower low here, this is a higher high. Here's a lower high. Here's a lower low. Once you have that lower low, it becomes more likely that the counter trend line will break and yield impulse movement. So that's where we want that, when that direction changes in line with the overall pattern. It's pretty obvious that you have a negative growth pattern here or a downtrend, right? A bear market, pretty obvious. Now, why is that? Well, you guys know the joke, right? On a trading floor, if someone said, why is that? You'd have three guys jumping all over them going, who cares? It was very important to us on the trading floor that we understood that we don't need to know why a market's going down to make money. In fact, by the time you give it that extra beat of time to think why, you missed the trade. It's down already. It's already moving lower, and you're the guy that's got to sell the lower low, right, if you want to participate in that. So who cares? Well, the truth is, it's not, that may be true to a degree, who cares, but most of us need to know why something is occurring because it gives us more confidence, particularly when it comes time when we need to demonstrate to ourselves that we can really do this. So it really is human nature to know why something works the way it does. I think you'll be a better trader long term if you have a good understanding of why a method works. You're going to embrace it more. And truth be told, you don't need to be in a big hurry to get short a market or get in a position in the market, because if the markets truly typify fractal geometry, and from my perspective they do, then they're going to just continue to repeat these same patterns over and over again. So there's really no hurry because, it's missing a trade is like missing a bus. They come along every 15 minutes. Well, from our perspective, not every 15 minutes because we like to trade with those higher time frames. But you see the point. There's always going to be another trade. Looking at this chart, boy, there's so much you can learn on any one chart. I could just look at this chart and I could tell you that the day-to-day news flow was definitely negative at that point because the pattern on the chart is absolutely a reflection of the underlying fundamentals. So the pattern on this 4-hour chart is negative because the flow of the day-to-day news is negative. So absolutely what you see on the charts are reflective of what's going on. FX Learner, what type of pattern is it? It's a pattern of lower highs and lower lows, reflective of negative day-to-day news flow. So once again, it comes back to you're interested in when direction shifts in line with the price pattern. Bam, bam, bam. Pretty simple stuff. Yeah, that's right, Ivan. It's a downtrend. Perfect. Now, this occurrence, which we just described here, where we circled the red circles, that's what we call a change of direction. An even more simplified way to look at this is we're selling rallies in a downtrend, right? So that's all we're doing. You want to identify the pattern as a bullish or bearish, and then if it's bearish, you're going to wait for rallies, and you're going to look to sell the rally, but you still have to wait for that counter trend line break. Once the counter trend line breaks, that's when you need to wait for the change of direction in line with the pattern. So once again, we're just highlighting it's very important to know when direction shifts in line with price pattern. Here's another chart I haven't updated. This is a weekly chart, and we circled it. I think the day we gave a pattern, we circled this candle the day it happened, I believe. We were in here on a Tuesday, and it had just broken down. I think it had given a signal the following Friday, maybe. But yeah, that was a signal there. Now, where's price at now? It's down here. So we're always interested when direction shifts in line with the price pattern. So we probably need to spend a little bit of time defining that change of direction, because that's what you need to know. When direction, it's the pattern is pretty much easy enough to see, but it's that change of direction you have to be aware of that occurs in line with the pattern. So a change of direction, as we teach it, is a trend line break plus a directional line shift. So change of direction equals trend line break and directional line shift. Directional line defined. I'm not going to go into this too much. I want you guys to take a moment to write that down. FX learner here. I think I see where you're going here. Write this down though. Directional line defined. You need to know that. Directional line defined, the low of the highest closing candle in an uptrend, the high of the lowest closing candle in a downtrend. This is a very important tool for us in determining when direction shifts. So hopefully you guys got that. The low of the highest closing candle in an uptrend, the high of the lowest closing candle in a downtrend. Very simple. How the directional line is used, and we'll demonstrate this, is if price is closing below the directional line, then the direction is down. If price is closing above the directional line, then direction is up. Let me give you an example really quick of a directional line so you can follow along with me. Here, let me go up to a daily chart, and I could show you this. Can everyone see the chart here? I just pulled up the Euro chart because that's what I had up here. Let me get rid of that. Okay, the directional line is going to mark the low of the highest closing candle in an uptrend. So at this point in time, this is my highest closing candle, right? So you're going to draw a line on that low. That low is going to be your directional line. So as long as price is above that line, then the direction is up. So every time you get a new high, it's going to paint the low of the highest closing candle. Not the highest closing candle, the low of the highest closing candle. So every time you get a new high close, the line is going to repaint. Here, the line stays the same. Here, the line stays the same. In fact, the line, that area, the low of that highest closing candle, looked like it became support right there, right? Then, bam, you blast it off. Now, this becomes my highest closing candle. So the low of that highest closing candle is very important. Boom. You have a change direction right there. Well, that was a sharp one, too. You changed the direction. You closed below the low of the highest closing candle. Now we're going to go from marking the low of the highest closing candle. Now we're marking the high on the lowest closing candle. So direction changed. So every time we get a new low close, like on that high then, this high right there, that becomes the high of the lowest closing candle. See how it became resistance right there too? And now look at it, it's starting to roll down here because you couldn't get through the high of the lowest closing candle. Bam, look at that. Tried 1, 2, 3 times, third time couldn't get through it, pow, they smacked it. Now this becomes the high of the lowest closing candle. Okay, so hopefully you guys follow me with that. I'm going to go back to the PowerPoint. So that change of direction, very important to us. Change of direction equates to a reversal. So you go look at the eyes on the left bottom chart there. There's that definition again. I think that's what you were looking for, FX Learner, right? Price reversal equals trend line shift plus directional line shift. I just showed you what the directional line was. Here, this is a weekly chart. And by the way, you're only going to have one directional line per chart. And again, if price is above the directional line, the direction's up. If price is below the directional line here, see price close below the directional line at that point. That's when, here, I'll highlight that directional line itself. Once price closed below the low of the highest closing candle, then the direction shifted to lower. It also took out a trend line break. That's significant. If you can have a change of direction, technically it could take out the low of the highest closing candle in an uptrend, but if it doesn't take out the trend line, you don't have both conditions met for the reversal. Here's the downside, the other side of it. Here's the lowest closing candle, not the lowest closing candle, not the lowest candle, the lowest closing candle. See the high on that? Let me highlight that for you. The green box there, see that high of the lowest closing candle? Once you close above that, and the trend line, then you have a price reversal. This itself is what we call a change of direction. Anytime you close above that directional line, the directional line is going to shift from marking that high to this new low. You have a change of direction. If you have a change of direction and a trend line break, then people, you have a reversal. So that's important stuff to us. If you want a more detailed explanation of this, Mastering Trade Selection and Management by McGraw-Hill, Chapter 3 is going to give you in-depth discussion on that. And I think there's a link in there, too, to a site to give you more specific examples, too. So that should be able to help you, too. Now, before we go to the chart and show you how we identified setups and signals in today's market, I want you to understand that we're not showing you how to trade here. Far from it. We're showing you tactics that we use to analyze markets, to put everything in context so that you can make trading decisions. A big reason I don't give away so many trading tactics is I don't want you to think that you've got one piece of the puzzle and really all I've given you is a piece of rope just long enough to hang around your neck and hang yourself with, right? I think as a trading educator, we definitely have a responsibility to get good information in your hands. So before you take any of your hard-earned money in the marketplace, understand the need for education and experience, and you have to know how to put all that together. So I would definitely encourage you guys, anytime you're introducing a new wrinkle into your trading, go back to the demo account. I don't care how much experience you have, that's just smart. If you're introducing a new wrinkle, a new tactic to your existing plan, go to the demo account. If you're going to try a new plan, absolutely, that means that you have to go back to the demo account. So you have to understand the importance of the demo account so you can prove it to yourself in a demo account or perhaps even a micro or mini account before you risk real money in the market. The tactic we're showing you here is one that should help to keep you out of trouble, but the most important thing I can impart on you today is the importance of being educated, getting the education before you trade, before you're going to risk your live money. If there's one thing I hear all the time from experienced traders is, especially those I've worked with, is they're like, I wish I would have listened to you in the beginning when you said stay in the demo account. There's a myriad of mistakes you're going to make outside the method. It's how the mind works. Most of us, when we first come into trading, we don't understand that dynamic that we're wrong more than we're right. I guarantee you most of us are in life decisions too, not just trading. We're talking about everything. We tend to be wrong more than we're right because that's just how our minds work. We put ourselves first. We're always basing decision on our wants and our needs, whether we know it or not. Most of what we do is geared towards our wants, our needs, and you need to get in touch. You need to realign yourself with not your wants and needs, but the how the markets move. I'm not even going to say the market's wants and needs because that's not true either. Just get in line with how the market's moving. Your wants and needs need to be aligned with how that market moves. So that's very important for you. And the only way you're going to learn that is through experience. And ideally, you've got the right education in front of you too. So let me go to Australian dollar chart, and I think this should answer. Yeah, price action. That's right. Kimbo. All right, Fuji Kimbo. Let's get to the price action. Yeah, price action is absolutely number one. Let me go to a intraday chart, and I'll give you an example here. And this will answer some questions. Okay, before I said, well, I'm not always looking to trade every day. It's dependent on what the market's going to give me. This is a 15-minute chart. You see an orange line at the top. Let me go out to a 4-hour chart so you can see the big picture. The 4-hour chart, I always like to say that show me 2 weeks on a 4-hour chart, and I can tell you the existing news flow. So I could tell the news flow in a market just looking at two weeks data on a 4-hour chart. So we have very specific, we measure the chart. What's nice about technical analysis is geometry. We have very specific levels we use to measure and gauge a market strength. So I'm going back 2 weeks, and I'm taking this last downstroke here that created that low. Hey, by the way, that low, that purple line you see, all the way out to a weekly chart. This is important. Forgive all my lines here. There's a method to the madness. See that purple line on the weekly chart? What is that? That is a 50% retracement of the primary pattern of this market. Take the 2010 low to the 2011 high, you retrace that by 50%. Look, you have a big purple line there. You also have a big potential big double bottom on a purple line, right? So that's where that purple line came from, that you're seeing all the way down and dirty on that 15-minute chart. Let me go back to the 4-hour chart because that's where I could see it. So that's the purple line. So that means there's a bullish primary pattern on that primary. That means the primary pattern is bullish. It's also very relevant. If you're on support of a primary pattern, that means that primary pattern is relevant to you. If you're 100 miles away from the primary pattern support, primary pattern is not going to be relevant. In this case, the primary is becoming more and more relevant in Aussie dollar because you're right on it. Now, going back to the 4-hour chart, see that orange line here? I'll show you where that came from. Geometry is a beautiful thing. There, I just drew that. Oops, there we go. Let me pin it on there. And you could see where that came from. That the purple line is the 50%, and that this creates our zone. The purple line, the orange line, that creates a zone for us. In this case, it's a sell zone. It's always the same. It's very specific geometric numbers. So geometry is a beautiful thing. So you could see price got up to the top of that very specific zone here on the 15-minute. And what happened? It came down pretty good. Now, I'm also going to show you that that 2-week pattern, we're going to call that the day-to-day pattern. Because generally 2 weeks on a 4-hour chart, and it could be 2 weeks, 4 weeks. The day-to-day pattern can last pretty long. I mean, I don't want to get caught up in semantics, but obviously the day-to-day pattern is down. Now, also, if my day-to-day pattern is down, I want to check what my secondary pattern is also. Now, I could tell with the naked eye that my secondary pattern is down, right? So if my secondary pattern is down and my day-to-day pattern is down, that's pretty powerful stuff. I have basically, two of the major patterns, two of the very influential patterns down. So if I already have two patterns down and I'm on a 15-minute chart and I see I'm against resistance, then I get my change direction. Well, this is a great one here, very low risk trade too. This is the change direction. This is the highest closing candle right there. So I marked that low of the highest closing candle. So right there I have a change of direction. That's tipping me off. I have a change of direction against the higher time frame pattern line. That's a pretty good guy to go with. Now, I'm not awake then because I'm in here in the U.S. So I missed that trade. That's the trade I want, the trend trade. Can't get that. So I do have I have a potential trade here that I can look at though for my particular time frame when I come in, and that would be potentially the counter trend trade here. And you could see, well, first you see that purple line and that green line. A double bottom on a purple line, I don't mind, but it's still counter trend. So here that line came from here. You take that low down there, and I draw my pattern zone on there. See my pattern zone? Now it's a buy pattern. See up above, you're at the top of the sell pattern. Here you're at the top of a buy pattern. So that now here's a purple line. My rule is I need a double bottom on a purple line. Now if I go down to a 3-minute, I do see I had a double bottom on the purple line. Here you can see it clear with the 1-minute chart. Here's my double bottom on the purple line. A beautiful confluence, trend line and purple line. So I could take this as a counter trend trade. I honestly prefer to wait for the trend trade though. I'd rather get in a trade and I can go walk around or go fishing or take ride the bike or something. I'd rather have the market working for me. I want the trend trade here. I'm not so interested in the counter trend trade. But a counter trend trade, you can see that wasn't a bad trade to take, especially on that 3-minute. Now this is more of a trend trade here, the purple. There's a double top there's a purple line there, and I'll show you where that came from. I like this because now I have 3 patterns aligned here too, right? Here, I draw my pattern lines on there. See how I did that? So there's the purple line, there's the orange line. So that's a double top of the purple line. This is an interesting sell signal to me, but it's kind of late in the day. But you can see that on a 3-minute. That's not bad, right? So here's your double top. You see it? So you get short here. And you can ride that guy back down to this purple line, which would be your natural profit target too. And guess what? You just made a double bottom on that purple line. Essentially, your counter trend trade, though. This is a counter trend trade, so when you're in a counter trending environment, even a trend trade, you'd have to manage it like it's a counter trend trade. Yeah, I like candle patterns, Boyke. I mean, this is a V top. I love a V. I could take a V top on an orange line. I need a double top on a purple line. Yeah, and I don't care what the formation is. If it's in my zone, I don't care what you want to call it: double top, triple top, crown top, head and shoulder top, falling wedge, rising wedge, whatever the formation is. It's where it's at on the chart. And it all goes back to, is it a change of direction in line with that overall pattern? Now, I got something for you, and I got great news for you, too, because, here, let me get back on track here, the slideshow. Oops, let me try that again. And if you want to know more about these tactics, they're spelled out in that book, Mastering Trade Selection Management, at least how the change of direction, which is essential for you. That's a trigger. As always, we've got something for you. You can pick up our core concepts 1 and 2 for free. Go to IBUniversity.com, click on that. We've got great news. My marketing guy, he's always telling me, Jay, these courses are so good, and you demonstrate that time and time again. But for most people, though, when you're giving seminars, for most people, it's kind of out of their price range, and I understand that. And he's been on me for long time. Hey, why don't you price this so everyone can have it? And I came off the trading floor here in Chicago, and I think all Chicagoans, we think it's our God-given right that we get to be traders. I mean, I know that's how the attitude was on the exchanges, and it took me a long time to realize that that's not true. And so I kind of thought that being a trader was kind of a process of natural selection too. And, I know the value of what we teach, I mean, it's worth a lot. You don't give something that's worth a lot away. If you give something away for peanuts, you get a bunch of monkeys, right? And that's true too. On the other hand, back to the point, he's always like, well, you could sell more courses if you lower that price. And we're really not into lowering the price because we knew what we have. But he finally got through to me, and we even took it a step further too as far as making payments. So the prices you see on this site now, they're inflated. We're going with a whole lot lower price than what we're going with. It's going to be cool. I mean, it is going to be much more affordable. So I would say go to IBUniversity, pick up the free course anyway. Go get our core concepts 1 and 2, and that's free. And then keep in touch with us because I think we're a week or two out from rolling out everything new, and it's going to be a lot less expensive. So there's a whole bigger market out there. We're also talking with a lot of big firms now as far as supplementing their educational efforts too. So you see a lot of these freebies from the different brokers out there. We're all wondering, well, what do they do next? What's the next stage? Well, they need advanced material. They need the graduate material. They need the master stuff too. So talk with a lot of brokers too, and they're very interested in getting this in their clients' hands for a lot cheaper than you'd pay now if you paid that retail price. So pretty cool. What drew me to Forex? Boyke, I was always, to me, Forex and futures, they're the same thing. I don't care what, it's the S&P chart is the same as a Euro US dollar chart is the same as a Euro futures chart. Trading's trading to me. To me, a corn is the same as pound yen. I don't, I know of course it's not the same physically, but I mean, it's the same animal. I would trade it in the same way. What intrigues me about the currency markets, the financial markets overall, is they tend to hold trends better. They tend to be much better behaved technically. It's never ceases to surprise me how precise the patterns are on a heavily traded financial market, such as the currencies. About the only commodity I would even consider trading would be crude oil because it's heavily enough traded. It's a big enough market where it's actually a leading indicator market. But I love FX though. No, I trade futures and Forex, Boyke. I like trading the S&P E-mini. It's currently in a very precarious position. and I can't take buy signals on it. I can only take sell signals at E-mini. So I have that E-mini S&Ps are one where I just have to wait for sell signals. But I trade them both though, Boyke. But yeah, go to our site, IBUniversity.com, pick out core concepts for free. Also, be patient. Know that there's, we've made some pretty cool alliances, and the people we're making alliances are definitely, it's in their best interest to get, they want to see us get our core, they want to see an affordable rate, a much, much lower rate for our courses, and even spread it out where individuals can make payments. And I'm bold enough to say, well, that's great if they make small payments for it. I'll be willing to give them everything they need up front. Give them the core concepts, advanced, graduate. Give that to them up front on that first payment, and because you need to, hey, trading's tough, and I'm certainly willing to put my money put my word out there, basically. So it's going to be interesting going forward. Some of the moves we're making so that our courses are much more affordable than they had been in the past. But enough of the marketing. It's all about trading. I love that. Who is that? Fuji Kimbo said price pattern. Okay, hey, thank you very much, and thank you very much, FX Street, and we look forward to seeing you again next Tuesday. Ciao.